Looks like we've got the majority of folks here. Well, welcome. My name is Chad Harmon. I'm one of the partners here at A&I Wealth Management, and I'm fortunate enough to be your guide here and your host for today's Lunch and Learn titled Life and Taxes, a look at 2023. Before we begin, with respect to everybody's privacy, I want to make sure you're aware we are recording today's presentation. Therefore, we've made you invisible as well as put you on mute. However, we still encourage you to ask questions. You're able to ask Nick, our presenter, questions today. To do so, please utilize the chat feature that's at the bottom of your screen. You'll simply click chat and type your question into the window that pops up. I'll make sure we leave some time for Q&A at the end to get everybody's questions addressed. Without further ado here, we'll go ahead and dive into today's presentation. Let me introduce Mr. Nick Arndt. He is the Director of Advanced Markets for Transamerica. Nick has an alphabet soup of letters behind his name, including a CFP, his Chartered Financial Consultant designation, as well as being a certified life underwriter. What that means to you is he's bringing a lot of brain power to today's conversation. And since we're talking about taxes, I think that he's a great resource to have in our corner today. Quick background on Nick. Early in his career, his experience with advanced planning strategies turned into a passion to help others increase their financial literacy and achieve a lifetime of financial security. Nick worked to bring timely and relevant guidance to retirement, estate, and wealth planning strategies, as well as regulatory issues that impact ourselves as financial professionals, as well as our clients. He has traveled all over the country to present on topics such as IRA planning strategies, estate and trust planning, Social Security, and even Medicare guidance. Nick is a Denver native, recently moved down to Highlands Ranch, where he enjoys everything outdoors that Colorado has to offer, whether it's playing with water sports and in the rivers or exploring the Rocky Mountains. He has made maintaining an active lifestyle one of his top life priorities. So without further ado, I'd love to hand things over to Nick to begin today's presentation. Take it away, Nick.
Thanks a lot, Chad, and I really appreciate everyone taking some time out of their day to join us on this presentation. It's going to be very informative. I will guarantee that. I'm going to go through a lot of information. Don't worry, we're going to wrap up at the end with a resource for you all that we can get you if you do need so. But with that, our presentation today, Life and Taxes, a look into 2023. As always, we have to read this disclosure slide. So just take a second, read that. It's not meant to be tax or legal advice, basically. I'm not a tax expert, or, well, I could say I'm a tax expert. I've read a lot of tax law, but I'm not your tax advisor. So if you do have any questions, do feel free to maybe bring some of these questions up to your tax professional. A lot of the conversation we're going to have today is going to spark questions, so just keep that in mind. With that, today's topic, we're going to take a quick look at some life events to take note of throughout the years, and then we're going to really get into the meat and potatoes of the presentation, which is the IRS Form 1040, and just look at some certain areas of that. We don't have time to cover the entire 1040, but I'm going to go over some lines that you might want to take note of to look at your last tax returns 1040 and maybe jot down a few notes. And then I'm going to wrap up at the end, just kind of going over some regulatory changes the last handful of years that are impacting everybody. And then, what might be some prudent steps on planning for uncertainty moving forward, because the only thing certain is uncertainty. So let's start with taking some time to take note of personal life changes and tax time. So right now in the first quarter of each year is typically a great time to think about, what's happened in your life over the last year or so and take note of certain changes. Have you had any impactful events occur in your life, such as, new children or grandchildren, any marriages or divorces? If your parents are still alive, are you supporting them in any way? Have you had any setbacks in your financial goals, or set any new financial goals, such as maybe college savings or a vacation home? Have you had any job changes or promotions. What are your retirement expectations, and are you still on track to accomplish those goals? Do you have any insurance coverages that need to be reviewed? Now is a great time to review that. I'm willing to bet that everyone joining us today, including myself and all your financial professionals, are going to answer yes to this one. Have tax or regulatory changes had an impact in your plans or goals? Well, over the last handful of years, we've seen 3 or 4 bills signed into law that affect our taxes in some way or another. So just when you think, we know the rules from the last bill, it seems like another one is in the works, and a new one is signed into law that we need to freshen up on. And whenever anyone has experienced life changes, or there's a change in the tax law, so everyone right now, it will usually necessitate a review of your beneficiary designations. And we have a nice little beneficiary review worksheet. It's a great tool for this. It really just asks 10 yes or no questions to really help you spot any, what I would refer to as red flags that may warrant a deeper conversation with your financial professional regarding your beneficiary designations on any accounts that you can designate a beneficiary on. So for example, have any events happen that warrant a change or update to your beneficiary designations? Are any designations left blank? That's a big red flag. We don't want to put a non-probate asset through probate by unintentionally leaving our beneficiary designations blank. So that's a common and potentially costly mistake. Do you have both your primary and contingent beneficiaries listed? I've gone over a handful of cases the last year where unfortunately both the beneficiaries and the owners have passed away, and there were no contingent beneficiaries listed. So again, that non-probate asset's now going through probate. Have you considered what you would like to have happen if one of your beneficiary passes before you do, and you haven't had time to update your beneficiary designations? Well, have a discussion with your financial professional about the difference between per capita and per stirpes beneficiary designations to help you understand those options. And do you have any beneficiaries with maybe behavioral or credit issues, spendthrift issues that should be addressed? Do you have any trusts listed as beneficiaries? That's a big one due to the tax law changes recently. If you do, that trust document needs to be reviewed. And if it is designated as your beneficiary, is the trust or other restrictions really needed? So it's often important to know, that not only your tax status, but the tax status of your prospective beneficiaries. And so to give a couple examples here, if you're in a low tax bracket, but you have beneficiaries that are in a very high tax bracket, maybe implementing a Roth IRA conversion strategy might make sense now. Of course, on that flip side, if you're in a high tax bracket with beneficiaries in a low bracket, may not want to convert IRA assets to a Roth IRA. And then finally, do the recent regulatory changes and the changes in beneficiary options need to be discussed? Something to keep in mind, some restricted beneficiary designations, they can't be honored any longer because of the tax law changes. So it's important to review them, determine if an alternative option is needed to be selected, and conducting that beneficiary review with your financial professional is a great way to make sure that your estate is not only up to date with your goals, but also it's going to be able to follow the current laws and rules that are in place. So let's get into the key part of our presentation here. Again, I'm going to go through a lot of information here, but don't worry, we do have a resource at the end for you. So key lines of your IRS tax return form 1040. So if you want to really get a basic handle on your financial situation, the 1040 is just a logical place to start because it contains a lot of valuable information to help your financial professional understand your personal situation and ensure that you are not overlooking investment strategies. It covers family status, sources of income, deductions, retirement plan and IRA contributions, and exposure to net investment income tax. And it's also where your adjusted gross income and taxable income are calculated. And then from there, you can determine your total tax. And all of these are important in helping your financial professional tailor a plan to fit your personal circumstance. And the purpose of reviewing that 1040 is to identify financial opportunities. And in the interest of time, as I mentioned, we're not going over every single line of the 1040. Instead, we're going to focus in and just look at a handful of lines on that 1040 that may represent real opportunities for you. And so that includes in-service withdrawals if you're still working and when appropriate. We're going to talk about investment income reviews, non-qualified annuities, trusts, and IRAs. So here's how we've broken down the conversation for today. We're going to go through lines 1 through 9, the sources of income, what makes up these numbers, which lines are important. Line 10 then is adjustments to that income, the importance of that number. And then we'll get into line 12, the standard deduction and itemized deductions, or standard versus itemized deductions, I should say. And then we'll talk about line 13, which is a form of deduction for business owners with pass-through entities. It's called qualified business income deduction. And we'll get into then your taxable income, which is on line 15. And then also we need to cover other taxes, what this could mean, and why to keep a lookout for line 23 of your 1040. All right, so the first area we're going to look at is our sources of income, starting on line 1, and that is the amount reported on your W-2. So wages and salary are just the first step in understanding your tax status and your overall financial health. For example, that form W-2 will show whether you are contributing to a qualified retirement plan. And if you are, make sure you understand your options. The best way to do this is to get a copy of your summary plan description, and another document is a fee disclosure. These will help you understand your plan options and explore whether you might benefit from an in-service withdrawal opportunity. So have your financial professional try to review those documents and your plan options with you. In evaluating an in-service withdrawal opportunity, make sure that you're discussing your personal circumstances, because a rollover to an IRA may offer expanded investment options with investments that might not be available in your 401k, but there are good reasons not to roll over maybe at this point in your life. So these can include certain exceptions to that 10% penalty if you're under age 59 and a half, and lower cost investments, loan provisions, and creditor protection as well. Here's a couple resources if you're looking for tools to help evaluate a rollover, an in-service rollover. Ask your financial professional to review these. One of them on the left there is called our IRA rollover interview, and the one on the right I like a lot. It's called what we call IRA rollovers, what's right for you. They're designed to examine your personal circumstances and help determine if a rollover is the right move or not for you currently, right now, as we sit here today. That the IRA rollover, what's right for you, just ask some great questions on whether you may want to just hold off for the time being from doing a rollover. Now, moving on to lines 2 and 3, these are going to show common sources of investment income. And this is a great lead-in to a discussion with your financial professional on tax efficiency. So as a general rule, individuals in a very high tax brackets are most likely to benefit from tax-free income. But those in lower brackets might get a higher after-tax yield from taxable investments. And we'll revisit that when we get to line 15. With respect to dividends, it's important to note whether they're reported as qualified dividends or ordinary dividends, because qualified dividends generally are going to receive long-term capital gains treatment, and this can mean a more favorable tax rate than ordinary income. And we'll look at those rates in more detail in a couple slides. And this is also a great time to consider whether you're actually using this income. If not, you might want to consider letting it accumulate in a tax-deferred type investment. And this is important to point to consider is if you're currently receiving long-term capital gains treatment on that dividend income. And then finally, Schedule B. I'm going to reference a lot of schedules that are also attached to your 1040. Here's the first one. Schedule B should provide a list of investments that are producing this income, and you may want to consider whether consolidating those investments under one financial professional would help you implement a more coherent investment strategy. Now, moving on to lines 4 and 5, this is where distributions from IRAs, pensions, and annuities are going to be reported. And the distributions are broken down as gross distributions and then the taxable amount of those distributions. So if you show significant taxable distributions, maybe more than what you would like, this can be a good reason to revisit your income strategy from these sources. And when possible, an integrated strategy of withdrawals from IRAs, Roth IRAs, and taxable accounts may help you lower your taxable income. And positioning high-yielding investments inside a Roth IRA may be a good strategy to generate tax-free income for some people. A great example of a Roth IRA that's done great is the founder of PayPal. One of the founders of PayPal invested $2,000 of founder stock from PayPal in his Roth IRA. That $2,000 over 20 years grew to $5 billion. Now, that's not realistic to everybody, but that's an example of positioning high-yielding investments inside your Roth IRA. And then also consider leveraging lifetime income products in IRAs. And if you're married, think about turning your IRA into a joint IRA with a joint lifetime income product. And consider if you're making large withdrawals from your IRAs, that can give rise to concerns about your portfolio sustainability over time. Now, were you affected by the coronavirus? I think pretty much everybody was. If you were affected and needed some income, did you take a coronavirus-related distribution, a CRD? Well, the CARES Act allowed a individual that was under age 59 and a half to distribute, to take distributions with an exception to that 10% penalty. And that was from most qualified plans and IRAs, and that was in the year 2020. So it allowed you up to $100,000 withdrawal, no 10% penalty if you were under 59 and a half. You must have been eligible to qualify. And then those taxable distributions that aren't paid back, they could either be included all at once in your 2020 income tax return or ratably over the 3 years of 2020, 2021, and 2022. So this tax filing year for 2022 is going to be the last year. So please take note of that if you did take a CRD back in 2020. Special attention, anyone who did receive a taxable CRD in 2020 must include that remaining here now in this year. So pay attention to Form 8915-E if you did. Here we see line 6 is where Social Security payments are listed. We have an entirely separate presentation on Social Security that's over an hour long. So this is really just barely even scratching the surface on just a couple questions to ask yourself. If you're collecting and married, are you both collecting? If you're under full retirement age and you're collecting, and you're still working, is your work causing your benefits to be withheld? I think that's an important thing to note. I was fortunate enough to be asked to be on an Asset TV panel for a master class on retirement income. I did a lot of research before going on there, and I found that like anywhere between 50 and 70% of individuals file and collect Social Security prior to their full retirement age. And then when asked why they did that, half of them said the reason that they did it was just simply because they had the option to. So it had nothing to do with them needing the income. So just keep in mind, if you're prior to full retirement age, you're collecting Social Security and you're still working, there's a threshold that the IRS allows you to make in income before they start withholding some of your benefit from you. So just keep that in mind. How much is subject to tax? So it's either taxed at 0%, 50%, or 85%. And is there an opportunity to decrease your taxable income to lower the amount of your benefits that are subject to tax if you're in that 50% or 85% bracket? Now, line 7 on that 1040 is where you're going to report a capital gain or loss. And this number is calculated on Schedule D, as in David. If you're showing a substantial gain on this line, well, one thing to consider is whether the gain was a result of just a one-time transaction or something that's going to be recurring year after year. You also want to determine, the rate at which you pay taxes on those gains. So as we can see on this slide, the tax rate on long-term capital gains is either 0%, 15%, or 20%, depending on your taxable income. And short-term capital gains are taxed differently. They're taxed at our ordinary income tax rates, which are likely going to be higher. And capital gains are sometimes the result of active management or frequent buying and selling of investments in a taxable account. So some ways to manage those capital gains are to use maybe buy and hold strategy, leverage a tax efficient mutual fund or a tax deferred annuity, or implement tax loss harvesting. And different strategies are going to work different for different people, depending on your personal circumstance. But one thing to remember when utilizing the losses to offset gains in that tax loss harvesting strategy, you have to watch out for the wash sale rule. And this means that if you buy or sell that security that's substantially identical to the one that you sold either 30 days before or after that sale, the IRS could disallow that loss. So keep that in mind. Another thing, don't forget about the 3.8% net investment income tax. That affects single filers making over $200,000 or married filing jointly over $250,000. Now, line 8 on that 1040, that encompasses a bunch of many different sources of income, and Schedule 1 is going to provide more detailed information. And two sources to look at on Schedule 1 is to focus in on is trust income or small business or partnership income. And those are shown on line 5 of Schedule 1. So if you receive trust income, there's a couple questions to ask yourself. The first is whether you needed that income. So as we can see here on the slide, the taxation of irrevocable non-grantor trusts creates a very strong incentive to pay that income out to those beneficiaries of the trust, even if they don't want or need it. So on the other side, another question is whether that trust is generating enough income for you as a trust beneficiary. And so this can be an opportunity to review that trust investments with the trustee and a financial professional to really ensure that those investments are in line with the goals of the trust. And those are all sources of income, lines 1 through 8. And then so line 9 on that 1040 is where you add up all of those income sources, and this shows your total income on line 9. And now to move on, so we know our total income on line 9, but what are some adjustments to our income? Well, line 10 is where your adjustments to your income are reported. This is where maybe a business owner reports contributions to their employer-sponsored plan, like SEP IRAs or simple IRAs or qualified plans. And here it helps to be familiar with those contribution limits. So let's say if you're maxing out a plan, does it make sense to explore whether a different type of plan would allow for larger contributions? If you're self-employed and you have a SEP IRA, you may be able to make a larger contribution if you switch over to a solo 401k or even a defined benefit plan, or have both to really maximize your salary deferral. And then always it's important to review those investments within that plan. That always makes sense to have an ongoing review on those investments. And then line 10 is also where you deduct your IRA contributions. And so now at any age, individuals can make an IRA contribution. That changed with the tax law within the last handful of years. But the ability to deduct those IRA contributions is going to depend on your income level and whether you or your spouse is covered by a qualified plan at your work. And so if you or your spouse is eligible to deduct an IRA contribution, this may be a good way to reduce your overall taxable income. If you can't deduct a traditional IRA contribution, maybe look at whether you qualify for a Roth IRA contribution. Remember that if you elect to make non-deductible IRA contribution, it is up to you and your tax preparer to track that after-tax dollars in the IRA using IRS Form 8606 if you have non-deductible IRA contributions. Because when an IRA has non-deductible contributions, any future distributions that you receive will be prorated between the taxable portion and those after-tax dollars. So those non-deductible contribution amounts. And then, so for those with income above that deductible contribution limit to traditional IRAs, maybe you'll want to take a look at considering a backdoor Roth conversion. But we have to be aware of that aggregation rule, because if you have both pre and post-tax contributions in your IRA, when you go to do that conversion, the IRS is generally going to require you to convert those amounts on a pro rata basis. So in other words, you can't just cherry pick and convert the post-tax contributions without also converting some of your pre-tax money as well. So now that all those sources of income adjustments to that income are accounted for, your AGI, or your adjusted gross income, is going to be on line 11. So that's an important number to know, but let's look at now some deductions. Starting in 2018, with the Tax Cuts and Jobs Act, many common itemized deductions were now eliminated. So as a trade-off, the standard deduction nearly doubled. So in 2023, standard deduction for single filers, $13,850. Married filing jointly, $27,700. Well, what does this mean? Likely, more people will be taking that standard deduction moving forward because they no longer have enough deductions to itemize to hurdle over that standard deduction amount. And so if there's a number on line 12, if that's more than the standard deduction, meaning you itemized your deductions, well, then Schedule A will have a breakdown of where those itemized deduction totals came from. And so are there any deductions that were just a one-time deduction, or will the deductions continue? You know, so a couple examples: medical deductions, or maybe a one-time gift to a charity. You know, this is going to give you an idea of what to expect for next year. And if there happens to be excess deductions, meaning deductions that exceed your income, don't forget that you can use those to maybe offset a Roth conversion. Another deduction that I mentioned is on line 13, qualified business income deduction. So if you're a small business owner and you have a pass-through entity and you do not show a qualified business income deduction on line 13, ask yourself, were you phased out of it because of your income level? If you were, would a contribution to a qualified plan decrease your income to help you qualify for it? And then line 15, that's your taxable income, which is your adjusted gross income less your deductions. And this is what determines your tax bracket. It's arguably the most important piece of tax information on your 1040, because calculations for fixed income investments, such as your after-tax yield or your taxable equivalent yield, that includes your highest marginal tax rate. So knowing your tax bracket is going to be a crucial factor in determining whether you should invest in taxable or tax-exempt fixed income investments. And it's also going to determine whether you're hit with the 20% long-term capital gains rates. Now, that final line on that 1040 that we're going to review is line 23. Line 23 is other taxes. Think of this section as a not a good one. Think of it as a penalty section. So penalties can increase the amount of taxes that are owed. So if you have an entry on line 8 on Schedule 2, it could mean that you took a pre-59.5 withdrawal from a retirement account that did not fall under an exception, and you're being penalized for it. You're being taxed at that 10% federal tax rate. Now, these accounts can include IRAs, qualified plans, and annuities if you have gains in them. If you plan on continuing to take withdrawals from this source and you are still younger than 59.5, talk to your tax advisor or your financial professional and talk about ways to help avoid those penalties in the future. And then an additional tax that could be the result of what's called excess accumulation. This can occur if you make contributions to an IRA or qualified plan that exceeds the maximum IRS allowed amount. And it can also mean that you may have failed to take a required minimum distribution by the due date. And the rules surrounding IRAs have always been complex, and you may not have the patience to really read through all those IRS publications and the rules. So this is an area where tax and financial professionals can really help navigate the rules of the road and help avoid penalties or mistakes. And then also let's look at the net investment income tax. So if line 12 on your Schedule 2 has a number, you are assessed 3.8% net investment income tax. This means that you had investment income above certain thresholds of modified adjusted gross income. And again, those thresholds, 200,000 for single filer, 250,000 for married filing jointly. These thresholds are not indexed for inflation. So keep that in mind, because all of a sudden some individuals who weren't subject to this in the past, all of a sudden the next tax year could suddenly be subject to the net investment income tax, not realize it. So there's several ways you may be able to help avoid paying a net investment income tax. This is not an exhaustive list, but here's a few rules to kind of just keep in mind. Income from Roth IRAs, not included when determining whether your income is above those applicable thresholds. On the other hand, traditional IRA distributions are excluded from your tax, but added back to your modified adjusted gross income, so potentially creating exposure. Municipal bond income is excluded. Now, annuity income is subject to tax, but that tax deferral can delay recognizing that income into years where maybe your net investment income tax exposure is lower, and consider taking capital losses when available to help offset some capital gains. All right, so let's take a deep breath. That was a lot of information on the 1040. Let's take a look at what we need to keep an eye out in 2023 and beyond. So since that passage of the original Secure Act at the end of 2019, navigating the beneficiary options for qualified accounts has become a bit more challenging, because that law ushered in an entirely new category of beneficiary called the eligible designated beneficiary. So let's take a look at the different categories. If you're a surviving spouse, definition of a spouse is who's legally married. We get this question all the time. I just say, if you passed away, would the coroner put on your death certificate, would they check the box that says you have a surviving spouse? If yes, then you're legally married. Sometimes there's question on whether a domestic partnership would count. No, that does not constitute a legal marriage. So that middle, or the larger box, the second one from the left, this is that new category Secure Act ushered in, the eligible designated beneficiary. What is a definition? Well, there's 4 key bullet points. Somebody who's disabled, somebody who is chronically ill, a minor child of that account holder until they reach age 21, age of majority, age 21, or if they're in school, it could be later. And then beneficiaries who are not more than 10 years younger than the original owner. So that includes anybody who's older than the original owner. And then the non-eligible designated beneficiary is just a living person who is not a surviving spouse and who is not an eligible designated beneficiary. And then also we could have non-natural entities as beneficiaries, our estates, or certain trusts. Maybe we're leaving money to a charity or a corporation. Those are types of non-natural entities. Why is that important? Well, knowing what category beneficiary you may fall in, or that your beneficiaries may fall in, is what's going to guide their death distribution options. So we see here, the surviving spouses always have the most options. The eligible designated beneficiaries are still allowed a lifetime stretch payout. But on the other hand, what happened with the Secure Act, they took away that option for anybody who is not an eligible designated beneficiary. So non-eligible designated beneficiaries, the longest they can defer their inheritance from a qualified account now is 10 years. And then non-natural entities, the longest they can defer is 5 years. They can either have lump sum, an out in 5, or if it's an annuity, they could potentially seek an annuitization option. Here is one thing to note on the post-Secure Act beneficiary RMDs. So we need to understand these rules, because there was a lot of conflicting information, a lot of professionals in our industry who are tax lawyers who are very good at reading legislative bills and laws, had it wrong from the start. And the IRS didn't come out with some clarification until late last year in October. So if you have a situation where you're electing an out in 10 or your beneficiaries are electing an out in 10. Do they have required minimum distributions due years 1 through 9? Well, it depends on how old the original owner was. Were they already collecting their RMDs and they were passed away on or after their required beginning date? Then RMDs do need to continue years 1 through 9, and then that account needs to be fully liquidated in year 10. However, on the other side, if that original owner passed away prior to their required beginning date, then there are not any RMDs due years 1 through 9. That beneficiary account just needs to be fully liquidated in year 10. And then there was some relief that was given because of all the confusion. The IRS came out at the end of October last year, provided penalty relief for those RMDs who may have been missed in years 2020 and 2021. But RMDs now are going to need to be taken for 2022 in this year, in 2023, for these accounts if they're due. So, please, if you have a out in 10 type of account, please do a review of that to determine whether your RMDs are due to be taken in 2023 for 2022. And now we have an additional tax law that was signed at the end of last year, the Secure 2.0 Act. This was real heavily to do with a lot of qualified retirement plans, but these are specific provisions I pulled out that I thought might be interesting for specific individual taxpayers. So some of those, and this is by far not even close to an exhaustive list of all the important ones, but just what I had room on the slide for: further increase in RMDs, right? Okay, so years ago it was 70.5. Secure Act moved it to 72. Well, now Secure 2.0 Act is moving it to 73, and 10 years down the road, it's moving it even further out to age 75. They're reducing the missed RMD penalty. It used to be the largest penalty the IRS assessed was at 50%. Now it's either going to be 25%, or if it's corrected in a timely manner, a missed RMD is going to be assessed a 10% penalty. There's additional catch-up contributions for individuals who are aged 60, 61, 62, and 63. They've also indexed the IRA contribution catch-ups to inflation, which is great because that number used to not be indexed for inflation. They've eliminated RMDs for employer plan Roth accounts. So if you have a 401k that has a Roth component, that used to require you to take RMDs out of it. What this did was basically level the playing field with Roth IRA accounts, because RMDs are not due from Roth IRA accounts. So they determined, hey, it makes sense. We need to eliminate the RMD requirements for employer plan Roth accounts. Now, starting this year, also, if you have a SEP and Simple, you can elect Roth contributions. You never were able to do that in the past. So keep that in mind if you have SEP and Simples. I mean, also, if you have an employer match option, you can indicate and elect that you want those employer match options to go into a Roth contribution. And then there's a plethora of new exceptions to the 10% penalty. Some go into effect in different years, but it's just worth noting that there are new 10% penalty rules, meaning if you're prior to 59.5, you need to access your income from your qualified plans or IRAs. There are some new exceptions out there. This is a piece my team put together, a summary of the Secure 2.0 Act. This focuses specifically on a lot of those bullet points I just went over, and even goes into a few more detail on a few other ones as well. So feel free to ask about that. So with all that uncertainty, it can be really difficult to just have a set it and forget it approach to your financial plan. And it's hard to make, drastic changes when we don't know what to expect. So one way to help plan for that uncertainty is by having a conversation about tax diversification. We all know what portfolio diversification is, that, investing in different asset classes. That's not what I mean by tax diversification. Tax diversification is the practice of diversifying assets across different account types that have varying tax characteristics. So tax-free, tax-deferred, or taxable. And then in a changing tax policy environment, tax diversification is going to help you withdraw assets from those optimal accounts. It's going to give you that flexibility, allow you to draw that income from the most tax efficient source at the time. It's going to create a hedge against those potential higher income taxes in the future. We already know, as we sit here today, if nothing else changes, the Tax Cuts and Jobs Act, which reduced our marginal income tax rates, is set to expire in 2025. That means our taxes are going up in 2026 if nothing else is done. It may reduce your overall taxes due to bracket creep. For those individuals that are right on the cusp of, one marginal tax bracket and the next one. And then portfolio longevity may help portfolios to last longer, to have a tax diversification plan implemented. How do you know if you're in a good spot? I encourage everybody to take inventory. You don't have to jot this specific kind of chart down, but just take note. What not only overall dollar amount you have in each of these types of accounts, but I'd say more of the percentages. We kind of want to have somewhat of a balance. We don't want to have 100% in all of them or in any given one. So, take note of how much percentage-wise your investments are in currently taxable accounts versus how much are in tax-deferred accounts and how much is in tax-free accounts. And if you have any deficiencies, now's the time to develop that plan for that tax diversification. Why is that important? Well, planning for that uncertainty, economic, other factors, be concerned for you all right now. Potential legislation is not going to be just the only concern. Inflation, we've heard a lot about that over the last year or so. It's going to erode your purchasing power. The cost of goods are going up, unfortunately. That also has had some other ramifications in the financial sector recently, with a few banks getting in trouble because of inflation and their balance sheets. Future of Roth accounts. I think this is often overlooked. I can't hammer this enough because it feels like it's always a trading horse in Congress. I feel like maybe not the majority, but somewhat half of the Congress always wants to get rid of all of our Roth options because they think it's bad because of that example I gave with that PayPal founder. How was he able to turn $2,000 into $5 billion that's going to come back to him tax-free? Some congressmen and women feel that might be taking advantage of the opportunity and unfair. And then on the other hand, there's like half of Congress that wants to, what my team calls Rothification. They want to open up the door for more Roth opportunities, which they did with Secure 2.0 Act. But that doesn't mean that all of these are safe, because at any point in the past, they've talked about possibly capping those account balances, meaning if your Roth IRA account hits a certain threshold, you've got to distribute anything above that. Or they could even eliminate those backdoor or mega backdoor Roth contribution strategies. So keep that in mind. Yes, that's an option now, but it might not be on the table if you delay into the future. And then possible income caps for Roth conversions. Right now, you could make any amount of money and still do a traditional IRA to a Roth IRA conversion. There has been some talks in the past about eliminating that, or at least capping that at an income threshold. And then the interest rate environment. This is concerning everybody. I put in here in parentheses, we just updated this presentation a month ago. And at that time, the Fed suggested interest rate hikes were most likely in 2023. Well, what happened within the last week? We've had a few banks get into some trouble. And due to those recent events, now there is some talk that their mindset may be shifted. I heard the next Fed meeting in March, it's now 50-50 whether they're going to increase the interest rate or not. And there's even talks I've heard of them possibly making decreases at some point in 2023. So we just don't know where the interest rates are going to be. That's why it's important to have tax diversification to plan for this uncertainty. And obviously, we've seen, the cost of financing is increasing now due to the current interest rate environment. With that, just to wrap up here, this is the picture of the cover slide of the resource that I mentioned to you. So, few final thoughts here. after you review your 1040, have you had any life events that occur that warrant that update to your estate plan and beneficiary designations? Is there any opportunity to put money into retirement plans, or move what type of retirement plan you offer if you're an employer? Were you subject to tax penalties? Let's take a look at that and try to figure out, get a handle on those. Did you take a coronavirus related distribution? Please take note of that, because this year is the last tax year, your last tax filing season, to take care of that. So this is the guide that we can offer. And then just to wrap up, a 1040 review can give you a great snapshot of your financial health and can also lead to important planning conversations with your financial professional and your tax professionals. So as you've seen, that 1040 really can hold a lot of planning opportunities, a lot of information. In most cases, more information that you can provide for your financial professional, the better. And that 1040 can help your financial professional uncover some valuable information that you may not even think is important. So with that, I'm going to hand it back over to Chad, but I do appreciate everybody joining us today for Life and Taxes, a look into 2023.